The most dangerous financial advice in America isn't in a scam email. It's in your company's HR packet, it's on every personal finance subreddit, and your uncle probably told you at Thanksgiving. It's 4 words: max your 401k. And the data shows that the people who retire with the most money, the ones genuinely comfortable, not just technically a millionaire on paper, almost never did that first. This isn't a quirk. It's a pattern, it's explainable, and by the end of this video, you'll understand exactly why the standard retirement playbook optimizes for the wrong thing. Fidelity's latest data shows the average 401k balance at year-end 2025 was $146,400. The median, the number, right in the middle of all the accounts, was $34,400. $34,400. Meanwhile, Northwestern Mutual's 2025 Planning and Progress Study found that Americans believe they need $1.26 million to retire comfortably. You do the math on that gap. That's not a savings gap. That's a chasm. And here's the thing that should catch your attention. According to Vanguard's How America Saves report, on average, Americans saved 7.7% of their paycheck in their employer-provided retirement plan last year. That was a record high. And only 14% of participants contributed the annual maximum. 14%. So almost nobody is maxing out. And yet the conventional wisdom says that's the move. Max the 401k. Max it every year. But here is what the conventional wisdom is not showing you. The wealthiest retirees are not building wealth through one container. They're building it through a layered system of containers. And they made very deliberate choices about which ones to fill first, which ones to fill second, and critically, which ones have time bombs hidden inside them. I've spent more than 10 years surrounded by accountants and fiscal lawyers running a business. I've watched exactly how money moves, and I've got multiple hundreds of thousands of dollars deployed across different account types myself. I am not guessing at this. What I'm going to show you in this video is the specific structure that the people who retire richest actually use, not the structure that HR departments promote, not the structure that makes mutual fund companies rich, the actual one. There's one thing I want you to hold in your mind for this entire video. Think about a rain barrel. Everyone in America has been handed the same rain barrel, the 401k, and told to fill it as fast as possible. But the rain barrel has something nobody mentions at the orientation. There's a faucet at the bottom that the government controls. At a specific age, they open it. You cannot close it. And every drop of water that comes out gets taxed at your highest applicable income rate at that moment in time. The richest retirees figured out that the rain barrel is useful. It is genuinely useful. But it's one vessel in what should be a much larger water management system. And in a few minutes, I'm going to show you the container they almost universally prioritized above the rain barrel after the match. But first, let me show you something about the barrel itself that most people have never seen. In the early 1990s, a benefits consultant named Ted Benna found a loophole in the tax code that had been sitting there unnoticed for years. He turned it into what became the 401k. The original idea was elegant. Defer taxes today, pay them tomorrow at a lower rate when you're retired and earning less. The math made sense then. It still makes sense in certain scenarios. But the original idea made 2 assumptions that have quietly broken down for a lot of high-achieving Americans. Assumption 1, you'll be in a lower tax bracket in retirement. Assumption 2, you can control when and how much you withdraw. Both of those assumptions, for people who do this seriously enough, eventually stop being true. And the mechanism that breaks them has a name. But stay with me, because before we get there, I want to talk about something quieter and slower that's been happening to your 401k all along. Here is what I think of as the slow drain problem. Your 401k has fees. Every 401k has fees. What most people don't realize is how many layers of fees exist. There's the expense ratio of the fund itself. There's the plan administration fee. There's sometimes what's called a 12B1 fee, which is a marketing cost baked into your mutual fund, quietly extracted from your returns every year. According to a comprehensive fee analysis, The average 401k participant is paying roughly 0.71%, all in nearly 3 times what the expense ratio alone suggests. And for smaller plans, it gets worse. The average investment expense of plan assets for 401k plans with 25 participants and $250,000 in total assets is 1.37%. An extra 1% in fees can be significant when it compounds over time. Consider a situation where a 25-year-old expects to retire at 65, has $25,000 in retirement savings, saves $10,000 per year, and averages a 7% annual return. Paying just 1% in fees could cost the saver more than $590,000 over 40 years of saving. $590,000. Vanished. Not because of a market crash, not because of a bad trade, because of a fee that reads as 1.37% on a disclosure document that nobody reads. There's a story I keep thinking about. There was a guy, call him Marcus, who spent 25 years at a mid-sized company, consistently contributing to the company 401k, always picking the balanced growth mutual fund his HR department highlighted in the enrollment packet. He did everything right. He never panicked during 2008. He never sold. 25 years of patience. And when he finally sat down with a fee calculator before retiring, he realized the fund he'd been sitting in this whole time had an annual expense ratio of 1.2%. His identical contribution pattern, invested in a basic S&P 500 index fund at 0.03%, would have left him with over $400,000 more at retirement. He had been paying the equivalent of a brand new car in fees every 3 years, except the car was invisible and nobody talked about it. Some analysts put it even more bluntly. High fees defeat the purpose of having a 401k. Research from Yale University showed that high fees may effectively negate the tax advantage of a company's 401k for some younger investors. Let that sit for a second. The tax benefit, the whole reason you use this account, can be wiped out by fees alone, not fees plus bad performance. Fees alone. A 2024 fee study found that active US equity funds had asset-weighted average fees of 0.60% versus 0.11% for passive funds. And you can find index funds with fees below 0.05%. The difference between 1% and 0.05% across 3 decades is not a rounding error. It's the difference between a comfortable retirement and a tight one. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Now, the fee problem is fixable. Check your funds. Move to index funds if your plan offers them. That's table stakes at this point. But I want you to understand the fee problem not as a final answer, but as a signal that the 401k is a tax advantage tool that comes with constraints, costs, and rules that are not in your favor by default. The fee problem is the appetizer. What I'm about to show you is the main course, and it is genuinely one of the most underappreciated traps in American personal finance. Hold that thought, because I need to set something up first. In the next section, I'm going to show you a mechanism inside your 401k that makes the fee problem look like a paper cut. It involves a number 73 and a mandatory faucet that the government opens at the bottom of your rain barrel, whether you need the water or not. This is where it gets really interesting. You think the problem with the 401k is the contribution limit $24,500 for 2026, confirmed by the IRS last November. You think the constraint is how much you can put in, but actually the real structural problem is what happens when you've done it for 30 years and the account is enormous. Because at a certain point, a 401k stops being a savings vehicle and becomes a mandatory tax event. Here's how it works. Once you reach age 73, the IRS mandates annual withdrawals from your traditional 401k and other pre-tax accounts. And every dollar counts as ordinary income. That mandatory income can push retirees into higher federal tax brackets, trigger the taxation of Social Security benefits, and raise Medicare premiums by thousands of dollars each year through a mechanism called IRMA. IRMA stands for Income Related Monthly Adjustment Amount. You've probably never heard of it. Your HR department definitely didn't mention it. It means that when your income, including your forced 401k withdrawals, crosses certain thresholds, your Medicare premiums go up. Not by a little. A single retiree whose RMD pushes their modified adjusted gross income from $100,000 to $110,000 could pay an additional $888 per year in Part B premiums alone. A married couple crossing the second IRMA tier pays over $400 annually in additional premiums for both enrollees combined. The IRMA brackets function as income cliffs rather than gradual phase-outs. Crossing a tier by even $1 triggers the higher premium rate across the entire Part B cost, not just on income above the threshold. So here's the cruel joke. You spent 30 years deferring tax to pay it later at a lower rate. But by doing it aggressively enough, you created a situation where the mandatory withdrawal at 73 is large, it stacks on Social Security, which also becomes taxable once your income crosses a threshold. And together they push you into a bracket that is not lower than your working years. It might be higher. Let me give you a number. If you're 85 years old and not married, and you had a total of $2 million in your tax-deferred account at year-end, which sounds like a lot, but is achievable for a serious saver who started in their 30s. Your distribution period is 16. Your required minimum distribution for the year would be $125,000. That's not a withdrawal you chose. That's a withdrawal the government requires. Stack that on your Social Security, and suddenly you understand why people who did everything right are still getting surprise tax bills in their 80s. Many people saved in traditional 401ks and other tax-deferred accounts, assuming that when they started withdrawing money in retirement, their income tax rate would be lower. However, it's not unusual for retirees to find themselves in the same or even a higher tax bracket when required minimum distributions kick in. There's a character in this story I want you to meet. His name is Dave. Dave is 65 years old, just retired after 31 years at a manufacturing company. He did everything the pamphlet said. He maxed his 401k every year he could. He was disciplined, patient, never touched it. At 65, he had $1,400,000 in the account. He felt like he'd won. Dave retires, draws down the account carefully, collects Social Security at 66. Life is good. Then he turns 73, and the government opens the faucet. Dave's first required minimum distribution is roughly $65,000. Fine. But add that to his Social Security, let's say $35,000, and his income is now $100,000. He crosses the first IRMA threshold. His Medicare premiums go up. His effective tax rate is not what he planned for. The rain barrel he built so carefully is now draining on the government's schedule, not his. Meanwhile, Dave's neighbor, who I will call Gary, earned nearly the same salary for the same 30 years. But Gary made different choices. Gary got the employer match roughly 4 to 5% of salary in the 401k, and then stopped. Gary maxed his HSA every single year. Gary built a substantial taxable brokerage account alongside the 401k. At 73, Gary's 401k is significantly smaller than Dave's. His RMDs are smaller. His taxable income at 73 is more controlled. His healthcare costs are partially funded by 30 years of compound growth in a tax-free account. And the long-term capital gains on his brokerage account, if structured carefully, may be taxed at a lower rate than Dave's ordinary income withdrawals. Gary is happier. Gary never maxed his 401k. Here's the part that matters. The knowledge about the RMD trap is not enough on its own. Knowing the math and being able to build a system around it before you turn 40 are two completely different things. The people who get this right don't just understand the problem they built a specific layered architecture during their working years, and if you want to see that exact framework built out with 50 years of actual retirement data behind it, I put everything into a digital book called The Exit Code. It's not a motivational guide, it's a research-driven analysis of how retirement actually works, not how the brochures say it works. Inside, I cover the mechanism I just described, why tax-deferred accounts become a liability at a certain scale, and the specific dynamic withdrawal approach that replaces the blunt instrument of a fixed percentage rule. I also cover something I call the 4% trap. The retirement income rule that most advisors still use as gospel, even though the research it was based on is now 50 years old and assumed a very different interest rate environment. There's a section on what I call the 58% rule, the fraction of workers who exit the workforce earlier than planned, often due to health or layoff, and why almost nobody builds a buffer for that reality. And I cover the Social Security Bridge strategy, a specific sequencing approach for people who want to wait until age 70 to claim, because the math strongly favors that delay, but they need to fund the gap without cratering their savings. The book is built on decades of real data, not guesswork, and you can get it for less than a dinner out through the link in the description. Every year you leave this architecture unbuilt, the compounding works against you, not for you. Now, you might be thinking, okay, if not the 401k first, then what? And this is where we get into what I genuinely think is the most underused tax structure in the entire United States tax code. The health savings account is the only account in the US tax code with a triple tax advantage. Contributions are tax deductible, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. Read that again. Tax deductible going in, tax-free growth, tax-free coming out. No other account in the American tax system does all three simultaneously. The 401k does one. It's deductible going in, but taxable coming out. The Roth IRA does two. After tax going in, but tax-free coming out. The HSA does all three, and it doesn't have required minimum distributions. Unlike 401k plans and traditional IRAs, HSAs don't have required minimum distributions, so you can keep your money in the HSA until you're ready to use it. No government faucet, no mandatory drain, just compound growth in permanent tax-free status. For 2026, the annual HSA contribution limit is $4,400 for self-only coverage and $8,750 for family coverage, up from $4,300 and $8,550 in 2025. Individuals age 55 or older who haven't yet enrolled in Medicare can add a $1,000 catch-up contribution on top of those limits. So why is almost nobody doing this correctly? Because the HSA has a branding problem. It sounds like a debit card for doctor copays, and that's how most people use it. They put money in January, they spend it on prescriptions and dental visits, and it's gone by December. Only 13% of HSA owners invest their funds, leaving substantial money on the table. A 30-year-old investing $4,150 annually in their HSA could accumulate over $400,000 tax-free by retirement for healthcare expenses. Yet most people treat HSAs as glorified checking accounts, missing the most powerful tax advantage in the tax code. 13%. 87% of people with HSAs are using the most powerful account in the tax code as a glorified debit card. And here is what the wealthy retirees actually do. The strategy is counterintuitive. Instead of spending your HSA on medical expenses now, you pay medical expenses out of pocket during your working years from your checking account, and you invest every dollar of the HSA in a low-cost index fund. You pay current medical expenses out of pocket when financially feasible. Invest HSA funds for long-term growth. Save receipts for qualified medical expenses to reimburse yourself later, and allow compound growth to maximize the tax-free accumulation. This strategy works because there's no time limit on reimbursing yourself for qualified medical expenses. You could pay a medical bill today, invest your HSA funds for 20 years, then reimburse yourself tax-free decades later. Think about what that means. Every doctor visit, every prescription, every dental bill you pay out of pocket and keep the receipt for is a potential future tax-free withdrawal from your HSA. You are accumulating tax-free withdrawal rights over time while your invested HSA balance grows tax-free. You are using the tax code exactly the way the wealthiest households use it, not because they're hiding money or using shady offshore structures, but because they understood one rule that almost nobody talks about. There's no time limit on the reimbursement. Now here's why this matters for the argument about the 401k. According to the 2025 Fidelity Retiree Healthcare Cost Estimate, a 65-year-old individual may need $172,500 in after-tax savings to cover healthcare expenses in retirement. And for a couple, an average retired couple, both age 65, may need approximately $345,000 in after-tax savings to cover healthcare expenses in retirement. $345,000. That's a very large bill that is absolutely coming. The question is, what account do you pay it from? If you pay it from your 401k, you pay income tax on every withdrawal first. If you've been building an HSA for 20 or 30 years and investing it, you pay nothing, zero tax, on $345,000 in eventual medical costs. That differential is not noise, it is meaningful wealth. The prioritization order that most serious wealth builders use is this: contribute to the 401k up to the full employer match, because the match is an immediate 100% return and nothing beats that. And then stop. Max the HSA. Then max a Roth IRA. And only then, if there's still money left, go back and contribute more to the 401k above the match. This is not a fringe idea. It's the logical output of looking at the tax treatment of each account type mathematically and deciding which ones produce the most after-tax wealth over 30 years. The match captures free money. The HSA captures the triple tax advantage. The Roth avoids future RMDs. And additional 401k contributions above that are genuinely useful, but they're not the priority. Stay with me, because this next part changes everything. We've talked about fees silently draining your 401k. We've talked about the RMD time bomb at the bottom of the rain barrel. We've covered the HSA as the most underused tax advantage in existence. Now, I want to talk about something that doesn't sound exciting, but represents the single biggest structural difference between the people who retire at 52 versus the people who retire at 65. It's called the taxable brokerage account. And most financial advice doesn't even mention it. Here's the thing people get wrong. They think taxes are the enemy of a brokerage account. They hear taxable and they run the other way. But think about what a taxable brokerage account actually does. A brokerage account offers maximum flexibility and liquidity, allowing you to invest in a wide range of assets and access your funds at any time, though you'll pay taxes on earnings. In contrast, a 401k provides valuable tax advantages designed specifically for retirement savings, but limits your ability to access funds without penalties before age 59 and a half. Let me illustrate the cost of that restriction. Imagine you're 43 years old. You've been maxing your 401k faithfully. You have $400,000 in it. A business opportunity comes up. A partner wants to buy out a position, or you find a rental property in a neighborhood you know well, or the market drops 30% and you want to double down in a taxable account. Your 401k is useless to you for any of those moves. You can't touch it without a 10% penalty plus ordinary income tax on top. The biggest mistake early retirees make is neglecting their after-tax taxable brokerage account. It's the bridge between your working years and traditional retirement age, the account that gives you flexibility and freedom before you can tap your 401k or IRA without penalties. There's generally a 10% early withdrawal penalty if you take money out of tax-advantaged retirement accounts before age 59 and a half, plus ordinary income taxes on top. That's why having a sizable taxable portfolio is crucial if you plan to exit the workforce early. The brokerage account is not just for early retirees. It's for anyone who wants to retain agency over their own financial life. And the tax treatment is actually better than most people realize. Taxable brokerage account withdrawals only incur capital gains taxes, which are often lower than ordinary income tax rates. Long-term capital gains tax rates are 0%, 15%, or 20%, depending on your income level. Compare that to a 401k withdrawal, which is taxed as ordinary income, potentially at 22, 24, or 32%. For the same investment gains, the brokerage account charges you a lower tax rate at withdrawal, and you don't have to wait until 73 to access it, and it has no contribution limits. There's also a benefit almost nobody talks about. Investments in taxable brokerage accounts will receive a step up in basis when passed to heirs after death, reducing or possibly eliminating future tax obligations that your children or beneficiaries might face. Your 401k inherited? Under current rules, your non-spouse beneficiaries must drain the entire account within 10 years of your death, at their tax rate, at what are often their highest earning years. Under the new rule, heirs who inherited an IRA after 2020 must empty the account within 10 years of the original owner's death. As one certified financial planner noted, very simply, it adds to the tax burden of those who inherit an IRA or a qualified workplace retirement savings plan. It can move beneficiaries into a higher tax bracket, trigger payment of the net investment income tax, or, for older beneficiaries, trigger taxes on Social Security and Medicare premium surcharges. Now, you might be thinking, okay, but if I invest less in my 401k, I lose the tax deduction today. And that's a real cost. I'm not dismissing it. If you're in a 24% bracket today, a $24,500 401k contribution saves you $5,880 in taxes this year. That's real money. The question is, what does it cost you in exchange? It costs you flexibility. It costs you exposure to a future mandatory income stream you can't control. It costs you access to capital for opportunities under 59 and a half. And if your plan has high fees, it might cost you more in eroded returns than you saved in taxes. By the way, let me say this plainly, because I'm mildly irritated by how rarely it comes up in mainstream advice. Standard retirement advice often falls short for those with significant assets and complex financial lives. High net worth individuals require a more nuanced approach that goes beyond simple 401k contributions and the 4% rule. For this demographic, the most effective strategies involve a sophisticated blend of tax optimization, risk management, legacy creation, and income generation tailored to unique circumstances. Yet somehow, the advice you get from most sources is still max the 401k and wait until 65. That is advice optimized for a very particular tax situation, a modest income, a high tax bracket now, and a predictable lower income in retirement. It's not wrong in that specific scenario, but it gets applied universally to everyone, regardless of whether the assumptions hold. Let me be honest about something. The financial advice industry has very little incentive to tell you about the HSA First approach or about building a taxable brokerage alongside the 401k. HSAs don't generate advisor fees. Taxable brokerages with low-cost index funds don't generate advisor fees. A large, complicated 401k balance that requires professional management, that generates advisor fees. The incentive structure of the advice industry is not aligned with your optimal tax outcome. It's aligned with your assets under management. Now, let's talk through what this actually looks like in practice, because abstract arguments are useless without numbers. Imagine a guy named Kevin. Kevin is 42. He earns $150,000 per year. His employer matches 401k contributions up to 6% of salary, so that's $9,000 in matching funds if he puts in $9,000 himself. Kevin has two paths. Path A is the conventional wisdom path. Kevin maxes his 401k every year, $24,500 in 2026, inflation adjusted upward over time. He does this for 23 years until he's 65. Assuming 7% annual growth, he has approximately $1.4 million in his 401k. He feels good. He's a 401k millionaire. But here's what follows. Kevin has essentially no taxable brokerage account because he put every investable dollar into the 401k. If anything unexpected happens before 59 and a half, a health crisis, a layoff, a business opportunity, and an early retirement he wasn't planning for, he has no accessible capital without triggering a 10% penalty plus income tax. He has a massive tax-deferred account that will force him to withdraw tens of thousands of dollars per year starting at 73, stacked on Social Security, and he cannot easily control his tax bracket. Path B is the layered approach. Kevin captures the full employer match first, $9,000 of his own contributions to get $9,000 from the company, an immediate 100% return. Then Kevin maxes his family HSA $8,750 in 2026. He invests every penny of it in a low-cost index fund and pays his medical costs out of pocket, saving receipts. Then Kevin maxes a Roth IRA for himself and his spouse, $7,500 per person for 2026. Then Kevin puts the remainder into a taxable brokerage account, index funds, tax-efficient long-term holds. He also contributes somewhat less to the 401k above the match, accepting a smaller tax deduction today. At 65, Kevin's 401k is smaller than Path A. Kevin's, let's say, $800,000 instead of $1.4 million. But Kevin also has $300,000 to $400,000 in a Roth IRA, completely tax-free, no RMDs. He has $180,000 to $200,000 in an HSA, which will cover virtually all of his healthcare costs in retirement at zero tax. And he has $300,000 to $400,000 in a taxable brokerage account, accessible now, taxed at capital gains rates, with a step-up basis for his heirs. His total wealth is potentially comparable to or exceeding Path A Kevin. His after-tax wealth is almost certainly higher. His tax flexibility in retirement is dramatically better. And he had access to capital throughout his working years when opportunities arose. Kevin, you're a genius. No, Kevin just read different documents than the HR packet said to read. Let me give you the three-part framework that structures this. I call it the three-bucket order. Not because it's my original idea, but because it's the simplest way to remember the sequence. Bucket 1, the match. Always, always, always contribute enough to get the full employer match on your 401k. This is not negotiable. If your employer offers a matching contribution to your 401k or other retirement plan, take full advantage of this benefit. Employer matches are essentially free money, providing an instant return on your investment. Stopping at the match and going no further into the 401k above that point is not a mistake. It is a deliberate, strategic choice that opens up buckets 2 and 3. Bucket 2, the triple tax account. After capturing the 401k match, max your HSA. The HSA's triple tax advantage makes it mathematically superior to both Roth and traditional IRAs for healthcare expenses, which you will definitely have in retirement. After capturing the 401k match, maxing the HSA provides the best tax advantage growth available. Invest every dollar of the HSA. Pay your medical bills out of pocket. Keep receipts. Bucket 3, the open account. A taxable brokerage account has no contribution limits. It has no age restrictions. Its gains are taxed at capital gains rates. It gives you the flexibility to retire early, seize opportunities, rebalance without tax forms, and pass wealth efficiently to heirs. There's no cap on how much you can contribute to a brokerage account each year. This is especially valuable for high earners or dedicated savers who have already maxed out their 401k or IRA contributions and want additional ways to grow wealth. Unlike tax-deferred accounts that mandate RMDs at a certain age, brokerage accounts let you keep your money invested indefinitely. This gives you more control over your withdrawal strategy, allowing for potentially better tax planning in retirement. The 401k above the match goes into a 4th position in the priority order. Not never, but not first. Now let me return to Dave, the character I introduced earlier. Dave and Gary. Dave maxed his 401k for 30 years and is now at 73 dealing with RMDs, Medicare surcharges, and a tax situation he didn't expect. Gary captured the match, built the HSA, built the brokerage, kept the 401k at a moderate size. Gary at 73 has less in the 401k, smaller RMDs, healthcare funded tax-free, and capital gains from the brokerage taxed at 15%. Here's the kicker. Dave has more money on paper. Gary has more money after taxes. And in retirement, the only number that matters is after taxes. Dave spent 30 years optimizing for the wrong number. The reason this pattern repeats across the wealthiest retirees is not because they found a loophole. It's because they thought about the end state. They asked, when I need this money, what will it cost me to access it? A 401k dollar is not a dollar. It's a dollar minus your marginal income tax rate at the time of withdrawal. An HSA dollar is a dollar if used for medical expenses. A Roth dollar is a dollar. A long-term capital gains dollar is a dollar minus 0 to 20%. The accounts are not equivalent, and the difference compounds over decades into enormous real money outcomes. For Gen X, many of whom are approaching their retirement years, 52% have 3 times their current annual income or less saved. And the majority, 54%, believe they will not be financially prepared for retirement when the time comes. That is a majority of the generation closest to traditional retirement age. Not pessimists, not bad savers by conventional standards. People who did roughly what the standard advice said and arrived at 55 feeling behind. 3 takeaways you can act on before this video ends. First, if you don't know the all-in fee percentage of your 401k right now, find out today. Not the expense ratio of one fund, the all-in cost, including plan administration fees. If it's above 0.5%, identify the cheapest index fund in your menu and concentrate your holdings there. The tax benefit of a 401k disappears inside a high-fee plan over a 30-year horizon. Second, if you have a high deductible health plan available to you and you're not maxing your HSA and investing every dollar of it in an index fund, this is the change that will have the highest per dollar impact on your after-tax retirement wealth of anything I've mentioned today. $8,750 per family in 2026 every year, invested, compounding tax-free, with no RMDs, available for the 300+ thousand in healthcare costs that are definitively coming. Do this before you put a single extra dollar into the 401k above the employer match. Third, start building a taxable brokerage account in parallel, even modestly. Not because it's tax advantage it isn't, but because it's the account that gives you freedom. Freedom to retire before 59 and a half. Freedom to seize opportunities. Freedom to control your taxable income in retirement by choosing when to harvest gains. The 401k is a powerful but inflexible tool. The brokerage account is the flexibility layer that makes everything else work. Lazy investing built more fortune than crypto memes. And the laziest, most powerful structure is still a boring index fund in the right account, in the right order, for the right reasons. The people who figure that out at 35 end up laughing in the rain, watching everyone else scramble to fill the same barrel the government handed.